Hello, this is Sean Cornell, and welcome to Reflections on Investing with the Cornell Capital Group. To begin this episode, I'd like to go back in time a little bit to the middle of 2021. And this is post the COVID crash, and interest rates were still exceptionally low. So in June of 2021, we introduced what we called the CCG Unprofitable Index. And this was an index consisting of stocks, mainly speculative growth stocks, that hadn't earned a penny in real earnings yet. But up until that point, they were experiencing huge run-ups, they were up 300, 400, even 700%. However, in 2022, things began to change, and it wasn't so kind for those same companies. And in March in 2022, we did a Reflections on Investing episode called Crash of the High Flyers, where we showed that many of these same companies had completely erased their astronomical gains and even fallen further. So now, since the beginning of this year, investors' speculative appetite seems to have been reinvigorated. And again, many of those same companies are starting to experience large run-ups. So to further explain this recent phenomena, here is our senior advisor, Professor Bradford Cornell.
Thanks, Sean. And what you said brings to mind some papers I've written with my colleague Aswath Damodaran. And in those papers, we talk about the difference between the value game, if you like, and the pricing game. The value of common stocks is determined primarily or almost exclusively by two things: the cash flows the underlying companies produce and the risk-adjusted rate that you use to discount those cash flows. So from a value point of view, prices should change only when cash flows or discount rates change. But the pricing game is different. The pricing game reflects supply and demand in the market. And as Professor Damodaran likes to stress, that supply and demand is highly dependent upon mood and momentum and sentiment. And those are unpredictable forces that can have huge impacts on prices without any underlying change in fundamental value. So let's go over to the computer and take a look at what Sean was talking about. So here we are at the computer, and this is our first chart. And it plots two things. The blue line is an index of all the CCG high flyers. And the red line is an S&P 500 index fund. And you can see that beginning in January 1 of 2020, the high flyers just take off. And they rise all the way to where they're up over 350% by early 2021, whereas the S&P is only up about 20%. And then the crash begins, and they come all the way down till, as we get into 2022, the total return going all the way back to January 1 of 2020 is now negative, whereas the S&P remains up. And by the end of the period, the high flyers are down a significant amount, whereas the S&P is up about 10%. So it's very hard to reconcile that behavior of the high flyers on the basis of cash flows or discount rates. At CCG, we believe it has to be in part what Professor Damodaran said: mood, sentiment, and momentum. And there's a further indication of that if we look at the individual companies. These individual companies are quite unique. They're in different businesses. There's a used car company, there's a fiber company, there's an online shopping company, there's an exercise company, and so forth. But they all move up and down together as if they're riding a tide of momentum and mood as a group, despite being different businesses. And if we even add Bitcoin, which isn't even a business, it seems to follow the same speculative pattern. Now, the reason we stress this is we think you can think of the behavior of the high flyers as being like a thermometer that measures the extent of speculative fever in the market. It was very high in 2020 and then totally absent, in 2021, and then totally absent in 2022. But what about recently? Well, let's go back to our average index, and here it is plotted just from the January 1 of 2022. And you can see that the speculative high flyer index has risen 75% in the first month plus of this year, compared to the S&P, which is up about 7%. So we are again seeing some evidence of speculative fever. And if you look at the individual companies, that's pretty much the same thing. All of them are up. Carvana is up the most. It's up 175% in less than a month. But we still see this behavior where all the speculative companies go up together. And if we put Bitcoin back, there it is as well, right in the pack. So we're concerned when we see this that the market may be acting a bit irrationally, and it underscores for us the importance of basing investment decisions on fundamental valuation. So if you went back and looked at our first chart, that average over the period from January 1, 2020 to the present, I hope it serves as a warning that the last thing you want to do in the market is to chase performance, particularly short-term pricing performance that appears to be unrelated to fundamentals. We believe at the Cornell Capital Group that investing amounts to very carefully assessing value and then comparing it with price and buying those securities for which value is significantly less than price. And while we will use the behavior of the high flyers to measure the temperature of the market, if you like, we will not use that as a basis for investing. This has been Reflections on Investing with the Cornell Capital Group. Thanks for joining us.